Yo, what's really good, people? Welcome back to the channel. In today's video, we're going to be talking about the top movers and fallers. We're going to be talking about earnings, talking about big tech, and of course, as you can see from the title of the video, I've bought a brand new stock. Done the market. Listen, I bought a new stock, wheel it up, and I'm going to give you not all the information about the stock, but I'm going to give you, some of the key bits of information of the stock that I have bought, why I've purchased it, and my vision for that purchase going forward. So if you want to know all of that plus more, please like, comment, subscribe, help the channel get to 8k. Follow on Insta and Twitter at Infinite Investors. And if you are new to investing and wondering what app is he using, I'm using the free trade app. The link will be a description and a pinned comment. freetrade.io/infinite-investors. Click on the link, sign up, deposit £1, and you'll get a free share of up to £200. Now listen, before I get into this video, just quickly, I want to say a massive thank you to everyone. You guys did it, man. You guys did it. Listen, I mentioned last week, obviously, if I can get 400 likes to keep this as a weekly series. I think you lot, landing on 470 or 465 or something like that. So you guys can do it. And just to give you a little fun fact, this video, because of all of the likes you guys gave it, became the #1 video of the last 10 videos that I've produced on the channel. Which is massive. So it just shows that little action of clicking a like actually makes a really, really big difference. So, from the bottom of my heart, I want to say thank you. I genuinely appreciate everyone that made the effort just to like the video. I definitely enjoy making these videos, but I want to make sure that, the channel's growing and it's getting out to more people. So, if you could be so kind to continue liking the videos and hit the like button on this video as well, it will definitely be greatly, greatly appreciated. But let's get into the top movers of this week. So the first top mover to talk about is a stock that was in the top movers last week and was the top mover last week. It's now the third top mover for this week, and that stock is always making dough. Jeez, listen. If you're new, you're going to find out that I'm very, very strange, yeah? And I make up names for my stocks, but it is what it is, man. You're just going to have to get used to it, or, go to Bloomberg or somewhere. Listen, always making dough has gone up 11.57%. Again, the percentages I'm taking from Simply Wall Street, so because I feel like they're a bit more consistent. And the reason why always making dough was the top mover last week, as I mentioned, was that AMD rose based off Intel's downfall. So Intel is a semiconductor company, the biggest in fact, and has the biggest market share. AMD, Nvidia, there's NXP, there's a few others out there that sort of vying for that market share as well. And AMD for me is one of the sort of high growth underdogs, basically, is the way I look at it. Now, Intel had a really bad earnings, and as mentioned last week, that prompted AMD's earnings to rise sky high. I think it went up about 16%. This week, AMD rose again, but it rose based off its own earnings. So it rose 11.57% this week because of its earnings update. Its earnings per share was 18 cents per share, which is really good for AMD. I think the last quarter or this time last year, I think it was actually a loss. The revenue was up 1.93 billion. That's a 26% year-on-year revenue growth, and an 8% quarterly growth. Their data center business, or one of their verticals, grew about 20%. And obviously they're in production of their 7 nanometer semiconductors, their Ryzen CPUs and GPUs and all that good stuff has been doing well. So yeah, AMD went up this week because of its earnings. A lot of analysts now have upgraded AMD to a strong buy, and some of them have upgraded it to a buy as well. And there's a lot of forecasts now that AMD will become $100 stock. I told you lot about 8 months ago, if you go back to my videos, that AMD will be $100 stock. That was my goal. And I said about 4 months ago, if I can get it to like $70 or $65, I'd actually be happy, because that, for me, I bought it around, I think the $40 mark, and then I bought more when it dipped below again. So I think we'll be able to see it here. Yeah, I'll see it here. So I was like, yeah, you know what I mean, that's 65. We'll get there. Obviously it blew past that just because of the Intel situation, and now it might just be on its way to becoming $100 stock maybe by the end of the year, man. So yeah, I'm definitely bullish on AMD. 93% up. I might put more in. I know it's gonna devalue my shares in the short term. I know that, and I appreciate that 93% might become, say, 50% or whatever. But AMD, I'm not selling at the end of the year. Unlike Shopify, where I felt that it was, you know, I sold at 224% with Shopify, and I felt that the rally was just so significant and so high and so quickly that I just felt like it was time to take Shopify's profits. I think AMD has still got like more years of growth in it, and because of that I feel that, you know, I can take a little bit of a hit on the profit now, load up a bit more money into it, and then, you know, over the long term see this rise. So I'm definitely going to continue holding AMD. I'm not going to be selling at 100%. I'm not going to be selling at 110% if it gets there. I'll just be holding on to it and probably buying more. Maybe a dip will come at some stage in the future, and that'll be my opportunity, but we'll just have to monitor it. But yeah, AMD is the first top mover of the week. The second one to talk about is PayPal. PayPal is the second top mover of the week. PayPal went up 13.62%, and again it went up based off stellar earnings update. So its earnings per share was $1.07 per share versus the 84 cents that was estimated. So it beat that by, I think, about 24%. The revenue was 5.26 billion for the last quarter. It added another 1.7 million merchants. Venmo, which is one of the applications that PayPal owns, predominantly in the US, in North America, their payment volume rose 52%. Their active users grew by 8 million. So across the board, PayPal has been doing some phenomenal work, you know, and also obviously because of the whole, you know, Divox situation, just reverse it and you know what I'm talking about. Because of the whole Divox situation, you know, people, an article I read found is that, you know, people stopped using their credit cards as much. So MasterCard and Visa actually didn't do as well, but they are looking at alternative payment forms, and that's why a lot of the transactions going through PayPal has actually been quite significant for its growth during this period. And, you know, the PayPal CFO, I can't remember his first name, but something Rayner, he basically talked about how, you know, he feels like the death of cash is, you know, basically here, and it's on its way. And there's some new products and services that PayPal is going to be launching by the end of the year. A lot of people think it's to do with cryptocurrency, so PayPal potentially allowing Bitcoin or other things to be either bought or sold or transferred via its network. So that's a likely possibility. It might be more acquisitions of smaller payment businesses that could potentially be happening. And obviously PayPal is a debt-free company with a lot of cash on its balance sheet and has the ability to do, you know, phenomenally well. And, you know, one of the CEOs that you all love, Elon Musk, was, you know what I mean, one of the founders of PayPal originally. So, you know, it's just a solid business all round, and I think it will continue to do well in the future. So yeah, PayPal up 13.62%. But now the top mover to talk about for this week is Pineapple, man. Pineapple, as you can see, look at that. You can just see that rise up right there. Pineapple went up 14.73% this week. Low battery, but we don't care. Let's keep going. And basically, the revenue went up 59.7. Sorry, the revenue was 59.7 billion, which is up 11% year on year. The earnings per share was $2.58 per share, which is up 18% year on year. So as you can see, they're making more in revenue on an annual basis, and they're becoming a lot more profitable on an annual basis as well. Now, one other piece of information that they announced this week, which you guys might have seen me share on Instagram and Twitter, is they announced their 4-to-1 stock split. So on the 31st of August this year, the share price is going to drop from $425 to around $100 per share, or whatever the equivalent is at that time, depending on the movement by that point. And you're thinking, what does that mean? Am I going to lose? No. They're doing a stock split. So a stock split is basically when a company's share price, or when a company feels their share price is too high and it's a bigger barrier to entry for, say, regular retail investors. And so in order to attract more regular retail investors, they want to make the share price lower. So what they do, they have their number of outstanding shares. They basically divide that by whatever the split is. So in this case, it's 4. So basically they times that by 4. Everyone who's got the existing shares basically gets 4 for every share that they've got. Now, they have done this previously. They did that in 2014, where they did a 7-to-1 stock split. The share price at that time was around $600. It went down to about $92, but obviously, for every share you held in Apple, you then got 7 shares in return. So effectively, the value stays the same, the amount you hold stays the same. It's just your share number increases because the share price is less, and then the whole goal is that it attracts more retail investors. So people always said to me, Curtis, what do you feel about the whole Tesla situation going to $7,000 a share, because Catherine Wood from ARK Investments says she thinks it'll be $7,000 a share? I've always said I don't believe it, not because I don't think Tesla's not going to grow, but because I don't think there'll ever be a share price of $7,000 a share. Like, I know Berkshire Hathaway, has their like $225,000 share price or whatever it was, but that's just because Buffett's being extra in it. He's just being extra. But I thought generally most retail companies and most retail businesses will do stock splits, and that's what I thought Tesla would do. So they'll do a stock split at some time, which means the share price might be around the 1,500 mark maximum. I mean, it's at 1,500 now, but it will never go to them sort of crazy numbers. Now, some people are saying, with the emergence of fractional shares, do you really even need to do stock splits, because you can buy percentages of companies? But just bear in mind that not every platform around the world has fractional shares. We're talking about US stocks here, which pretty much there's I'd venture a guess to say there's over 50, maybe 100,000 stockbrokers around the world where you can actually buy US shares, and I'd venture to say that not a lot of them have fractional shares as a default functionality within their systems. Think about all of the traditional banks, the old stockbrokers, etc. So I think it still has a benefit from a worldwide perspective. Yes, some people are using Robinhood. Yes, people are using Free Trade and Trading 212, where they do have fractional shares, so it's not that big a deal. But across the whole world, when you think about all of the different regions and jurisdictions and people investing into businesses like Apple, they don't all have those same capabilities that we do. So broadly speaking, it is a good move. Broadly speaking, you probably will see a benefit into the share price increasing because of it, but it's not directly going to impact the valuation of a business. Anyway, because of their earnings, Apple went up, what was it, 14.73%. And Pineapple's doing exceptionally well. Now, let's get into the top fallers. The first top faller to talk about is, in fact, my lowest holding right now, Taylor Wimpey. Taylor Wimpey was the worst last week. It was the worst top faller last week. It's now, not the worst this week, but it's still in the bottom 3, sorry. And Taylor Wimpey basically has gone down 8.96%. In fact, that these figures are accurate to Simply Wall Street, which is great. And one of the reasons, the main reasons why Taylor Wimpey's gone down is the house building company suffered a 40 million loss in the first half of the year, mainly due to the impact of Deva 91. The revenue halved, about 754 million in Q2. Completions of their houses slumped 58%. To 2,771 homes. If you compare that to last year, it was about 6,541 homes that were being completed during 2019. So quite simply, they down tools due to the Divock situation. This was completely expected, in my opinion, and I expected that a lot of these financial companies, when their earnings are going to come out because of the nature of Divock and the fact that everything basically shut down, it's going to be peak for them, and it's a bit peak for Taylor Wimpey right now. So obviously, that's the reason why they've dropped quite significantly. I am definitely on a mission to reduce some of my holdings and transition more to the things that I believe in long term, which is at the moment tech stocks, growth stocks. You US stocks, etc. Though I will, as I've mentioned, always have a number of UK stocks and a number of dividend stocks that I just want to have because I think they're good businesses regardless. Taylor Wimpey I'm not too sure about, so I'm a bit indifferent on Taylor Wimpey. I prefer Barrett as a house builder, if I'm honest, and so I think if I do sell, the money would either go to one of my growth stocks or it might go to Barrett if I want to sort of consolidate my holdings. But at the moment I'm at a loss of 28%. I'm not going to be selling, although the actual unit value is only a £500 and £400 loss for me, which in the grand scheme of my portfolio isn't that big a deal. But I'm not selling no 28.99%, so I'll hold on to it for a bit. I will average it down, and then, you know, I'll review the situation by the end of the year. The next stock that went down is Virgin Moolah. Now, that looks disgusting. That looks really, really bad, doesn't it? So Virgin Moolah basically went down 8.99%, and again it's just due to their earnings, and you know, some of their business units have just basically seen you know, a performance that is representative of the times that the last quarter basically gave us. Personal lending for them went down 2.7%. Obviously, people being furloughed, people are losing their jobs, they're not going to be taking out personal loans as much, and obviously that's how they make their money. There was lower spending on credit facilities, mainly credit cards. A lot less spending was happening on there. Their mortgage portfolio dropped 1%. So effectively, you know, during that period, there was much less new mortgage applications that were being taken out, if any. And so effectively, they saw a 1% drop, which is basically the amount of new applications that they probably would have received during that period. Their business lending did improve. That can be testament to the whole government support, though. So the government support, the government lending schemes probably was the reason for that. Their deposits have improved, which is basically, you know, a significant, like, reminiscent of the fact that you've got people not spending as much and they are hoarding, you know, much more of their cash and saving it just because of the time. So, you know, as I've always mentioned with banks basically work in the opposite way to humans and to people. You know, their assets is the amount of money they lend out, their liabilities is the amount of money they take in through deposits. So more deposits and less loans is bad for a bank, although it's good for us. And so that's the reason why obviously Virgin Money has dropped 8.99% this week. And again, Virgin Money, I think this was expected. It's not good to see. It does hurt, I'm not gonna lie. 17.09%, but again, in the grand scheme of things, it's only a £372 loss, so it's not crazy for me. I've got worse losses, which you will see soon, very, very soon. But yeah, for the time being, I will hold on to Virgin Money, average it, keep on averaging it down, dollar cost averaging into it, and yeah, we'll see what happens in the next, you know, in the next half of the year. The next and the last top faller to talk about is Lloyd's, man. Oh, what a picture. Listen, the amount of messages I've got on Lloyd's in the last week is ridiculous. You lot think I work? It's like I work there, man. Seriously, I feel like one of their customer service agents. I might have to get an IVR now when you lot message me on Instagram about Lloyd's. Like, press 1 for leave me alone, press 2 for leave me alone. Stop talking to me about Lloyd's. Listen, I'm only joking. You lot can talk to me about Lloyd's if you want. Lloyd's has gone down considerably this week, 11.48%. And it's due to their earnings. So basically, they made a £676 million loss. And the reason why is because they set aside £2.4 billion for bad loans. So effectively, all of their profit was gone. And basically, they are anticipating a surge in defaults in their loans or in customer loans in the coming months. And this is the reason why they had to make that provision and set aside basically all of their profit and a bit of obviously their cash flow in order to, you know, mitigate against that. Now, this is primarily due to the whole significant deterioration in the economic, you know, climate during that quarter. So again, it is kind of expected, but it isn't nice to obviously see. I personally dropped a K into it again. It dropped to 26, you know, cents a share. So for me, I had to drop another bag into it. So you can see how much I've been adding to it recently. And it just had to be done. I didn't want to. The money that I put into it, actually, I wanted it to go into the growth stock that I'm going to be talking to you about later on in this video, the new one that I bought. But I just had to do it, man. The price went down so much that I had to keep doing this. And I've always been an advocate for Lloyd's. You know, they are a profitable business, but every time their profit gets eaten into things like PPI or, you know, now this Divox situation. And so, you know, it's just something that's part and parcel of the times. I think potentially there's more bad news on the horizon when the GDP figures come out in the UK in the next couple of weeks, or maybe that's been priced in as well, so who knows, that might not have that much of an impact, seeing as, you know, the bad loan provisioning is due to the fact that, you know, the Divox situation, which is also, you know, going to be mirrored in the whole GDP situation. So it might already be there, but, you know, there might be a little bit more. I've always maintained that I think in 2021, when the dividends return, when hopefully this Divox situation has disappeared, I think Lloyd's will be, you know, coming back to, you know, at least the 60p mark, or, you know, somewhere around that region. Do you know what I mean? Even if it goes to 50p mark or something and it starts paying dividends, you know, with the amount that I'm putting into it now, it will actually be quite worthwhile. But for me personally, I'm 100% still holding Lloyd's. You can see the loss on Lloyd's of 24% equates to about £1,300, which is a significant loss. And so I'm just going to keep holding on to it. I know Lloyd splits opinion. I get a lot of comments from people that, you know, forget it, you know, cut off your losses and just move on to growth, blah, 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 blah. But I don't believe in that, man. I don't believe in cutting losses in stocks you genuinely believe in. And if you look at macroeconomic trends, and you can see that actually there's nothing fundamentally wrong with the business, but we are just in a cyclical period right now of constraint and turmoil that's going to have an impact on this business, then, you know what I mean, I think you just gotta, you know, be mindful of that. And I think when we look back at this period, you know, we will thank ourselves for holding firm, or hopefully I'll be thanking myself for holding firm. So I'm going to hold on to Lloyd's. It's down a lot, but it is what it is. So yeah, we just got to keep on moving. Now, earnings. Last week we mentioned that there was loads of different companies that had earnings, and they had earnings, but the stock still fell. So no, you know, we talked about Snapchat, who, you know, had a positive earnings, but their stock fell 5% over last week. We can see this week it's fallen again, you know, 1.8%. You know, we had a Micro Hard, which is obviously, you know, one of my holdings that I anticipated good earnings. It did actually have a good earnings last week, but the stock fell last week after its good earnings. And, you know, I put the money in just before the earnings, expecting it to be good, and, you know, it just failed me. Now currently my Micro Hard position was, you know, it used to be about 25%. It's gone down to 1.63, but it is what it is, man. Micro Hard is a long-term hold, man. I'm not worried about this. This stock will be $400, $500 in a few years' time, so I'm not too worried about that, man. I'll just keep on buying more from Micro Hard for the time being. The same situation happened with Netflix. Obviously, a lot more subscribers Netflix were basically seeing due to people staying at home. Their revenue was up 24.9%. But last week it dropped quite significantly, and this week again you can see it's dropped again. So we saw that trend. It even happened with Tesla. Tesla, you know, had good earnings. It slightly rose and then it fell quite significantly last week as well. This week again you see Tesla's fallen 7.07%. However, this week has been a completely different picture. We saw AMD, that's been up this week. We saw PayPal up this week. We saw Apple up this week. Obviously, you know, stocks that I hold. Shopify absolutely smashed its earnings, and Shopify has done well this week as well. Their revenue soared 97%, a 97% increase in revenue on Shopify. Yeah, man, Shopify did a madness. But at the moment, Shopify for me is still too high. I think it's having a bit of a turbulent time. I mentioned that I could get back into this stock, but I definitely want to see it drop down quite considerably. And I just think it's consolidating. It's going a little bit sideways at the moment, which I like to see. I think I sold at the right time. It was just over $1,000, and, you know, we'll see what happens with it. If it drops more significantly over the next coming months, and the valuation gets a bit more in line to the business, then I think Shopify might resurge within my portfolio. But at this current moment, I'm happy to have just taken my profit that I did, my 220%, and just leave it there. Facebook did phenomenally well. I know a lot of you guys hold Facebook. I used to hold Facebook, as you guys know. Facebook done well. You can see 8.9% 0.64%. You can see it's gone up, 11.71% this month. As you can see, I used to hold it quite some time ago, but yeah, I sold out of Facebook just because I didn't really believe that they would continue to grow as much. I felt that, the whole Libra situation, people moving sideways from it, I felt they were going to have a lot more regulatory pressures. And I just felt that, there was other opportunities. So, I can admit I was probably wrong. But yeah, Facebook's done well. Would I get back into Facebook? I'm not too sure, if I'm honest. I think there's still a lot of opportunities just in my watch list at the moment. But Facebook has done well this week, so well done to all of you guys that have held Facebook. Amazon has absolutely destroyed it, similar to Shopify, if I can actually spell Amazon correctly. So Amazon, this week went up 3.58%. You can see he's gone up 14.71%. But their earnings, man, they were expected to do $1.51 per share in terms of their earnings. They did $10.30 per share. I mean, that's just ridiculous, man. Absolutely ridiculous. Their revenue, 88.9 billion versus their 81 billion that's expected. So again, revenue's up, but their profits exceptionally up. And so Amazon did, really, really well. Again, these businesses, I like Amazon as a business, man. I just feel like it's too high, man. And I'm not really trying to buy one share for free. I'm just not really trying to, you know what I mean? Like, I think I'm being like nitpicky. Like, I don't know if I'm thinking about it the way I should be thinking about it. But like, I know it's a great business. I know it will continue to grow. I know it will continue to do well. But I just feel like it's just too high, man. I just feel like it needs to drop. But who knows? Some people are saying it's about to go to 3.5 by the end of the year, which would be like, about 12% increase, maybe something like that. I'm not too sure from where it is today. Maybe more, actually. Yeah. No, about 12%. It'll be about 12% by the end of the year. So I don't know. We'll see what happens if Amazon features. But yeah, I'm not really trying to buy one share for $3,000, man. I still think there is other growth opportunities that I might make a little bit more bang for my buck. The only stock that actually did the same as all of the stocks last week was Alphabet. So Alphabet went down, as you can see here, 2.71%. Again, their profit was up. Their profit was up by 7 billion. But the revenue declined year on year because of reduced advertising spend. So obviously all of the businesses cutting back on their digital spend, on their PPC spend. Then obviously that had a significant impact to, Alphabet's top line figures. And effectively, because of that revenue decline, they reported bad earnings on the revenue front, and their stock has actually gone down. So, it might continue to go down quite some bit. And Alphabet actually might be something that I could potentially consider getting into. But we'll see. I'm not like, head over heels for Alphabet either, if I'm honest. I think there's some growth stocks that I feel like I missed the boat on. Do you know what I mean? Just by virtue of when I started investing. So I'd rather find the next Amazon, the next Google, the next one of these stocks that in the next 5 years I'll be, very, very up. So, I mentioned last year that my 2020 vision, I want to transition from more of my UK dividend stocks into more of a US growth stock portfolio. I did that with Shopify, did that with Okta, Apple, Microhard, AMD, PayPal. And obviously in those situations, I put like 1K in each of those stocks just because, it was very new for me going from a dollar cost averaging strategy just to putting in a bit of a lump sum, or what I consider a lump sum. I know I had a lot of people telling me, I put 10K in AMD. Listen, good for you, fam. Good for you. I'm happy for you in it. But just hold it down before you have to link, man, innit? Before man has to link you. Anyway, I'm now going to increase what I do with any new growth stock. So if I do add a new growth stock, I think I've kind of proven my philosophy with what I wanted to do with the stocks that I previously bought. So for the new growth stocks, my aim is to put 3K in each of them as a starting base, and then obviously if they drop, I'll continue to add. If they rise, then I'll just leave it and obviously try and take the percentage growth. I couldn't put 3K into this specific growth stock this week just because of the Lloyd situation. As I mentioned, I had to put 1K into Lloyd's. And, money don't grow on trees, man. So I'll have to wait till, to end the next month before I see what I'm going to do there. But the growth stock that I am referring to that I put 2K into is Cloudflare. Cloudflare is the stock that I've added to the portfolio. Probably a lot of you won't know what Cloudflare is, so I'm just going to give you a bit of an oversight into what Cloudflare is and why I've invested and chosen to invest into this specific business. So yeah, Cloudflare is a web infrastructure and website security company. Basically, some of the services it provides is like WAF services, which is web application firewall. I don't want to get too technical. DDoS services, DDoS mitigation, which is basically protecting against attacks. CDN, content delivery network services, internet security services, distributed domain name server services, rate limiting, all kinds of basically protection around website security. It's basically about website security. So in the case of things like DDoS, some websites or some companies experience DDoS attacks, which is basically when somewhere in the world there might be a supercomputer or a machine that's basically trying to penetrate through the firewall and penetrate through these businesses' applications in order to put robots or to put different scripts in there, or to basically mess up their system and F up their bag for a number of reasons, you know what I mean? And systems and businesses, they turn to companies like Cloudflare to help protect their online ecosystem and protect their customers' data, protect just their basically their biggest asset, which is their business in itself. So one thing that I've learned through my growth stock investing, particularly around the likes of investing into businesses like Okta, is that I'm leaning towards these businesses that have a primary focus on serving other businesses, as opposed to businesses that are direct to consumer. Now, don't get me wrong, I have pretty much the majority of my stocks are direct to consumer. So this is not me saying that direct to consumer businesses are bad or anything like that. But I'm just feeling that I'm getting a bit of a leaning and a liking towards businesses that require that make generally most of their money from business to business transactions. Just because in the case of things like Cloudflare, you've got the fact that if they serve all of these businesses, which I'm going to get to a bit later, these businesses have to protect their asset. They have to protect their online ecosystem in order to continue serving you guys as customers. And so there's just certain expenses that they just can't afford to let go, and they just can't not have security on their systems. It's not something that they can just not do for a certain period of time effectively, whereas certain other businesses might say, in a DevOps situation, we're going to stop doing this or we're going to stop doing that. Businesses just can't afford to not secure themselves. Otherwise there is no business for them. So because of that, I feel like the moat of a business like Cloudflare means they're going to weather a lot of storms. Even there's going to be economic downturns or upturns, I feel like Cloudflare is going to be quite solid throughout those periods. The way they basically make their revenue is that businesses will pay them a license fee on an annual basis for a number of Cloudflare's products. They've got so many different products and services, so they might just take 2 or 3 of those products and then pay a negotiated license fee on an annual basis in order to sort of keep on protecting their business from whatever is they're experiencing. Now, Cloudflare actually went public. You'll see from here. Actually went public September the 13th. That's actually when it went public at $18 a share. And it's not like other IPOs, man. It's done really well. It's continued to rise throughout that period, which is, very, very good to see. And so it's now been trading for nearly a year. Just so you are aware, it is not a profitable company. However, similar to PayPal, it has no debt, which is one thing that I like to see. So in the case of a company that's got no debt, the next thing you've then got to look at is, for me personally, is their sort of cash runway. So they've got about $640 million in cash runway. So that basically means they've got about 640 million in the bank, right? Okay, so in and of itself, that doesn't mean anything. So how do you determine whether that's good or whether that's not? You then look at something which is called their burn rate. So how much of that cash do they spend on an annual basis? And they spend about 96 million on an annual basis. So if you work it out, basically that cash that they've got sitting in their bank will last them about 6.7 years before that cash basically disappears. So obviously they're not just going to allow that cash to wind down. They need to obviously get more money, and the way they get more money is through selling their products and services. So what you basically will see is that their revenue is up 49% year on year, and so their revenue, if that trend continues, then in fact we're not even going to ever see them run out of cash, because they'll actually start to break even in about 2 to 3 years, maybe 3 to 4 years when I worked it out, and actually hopefully become a profitable company. Now, their cash burn did increase 23% last year. There is a reason why why, which I'm going to talk a little bit later, which I believe is the reason why. It's not really clear that that's the reason why, but I believe this is probably one of the reasons why. But like I said, if the revenue continues on its trend, then this will become a profitable company very quickly. And, you know, we could be looking at a $41 stock now that in 5 years' time might be, you know, who knows? I don't want to give a figure. Do you know what I mean? I don't want to give a figure. It could be $300. It could be $350 a share, which then means it's a significant, you know, 700% return, which is why I'm really bullish on this specific business. Now, the thing that it launched this week, which is a private beta, which I think is one of the reasons, there's probably others that I don't know their internal business. I'm not there at their CFO meetings and that, do you know what I mean? But I think one of the reasons is they've launched a private beta of something called Workers Unbound, which is their serverless platform. An equivalent thing to this is AWS Lambda. So Amazon have their cloud platform, which is called AWS. AWS has a whole bunch of different applications and services that businesses can use. One of those services is called AWS Lambda, which is effectively the whole point of that is it takes requests and events from an application or from a website that needs to perform, such as, you know, upload a photo or refresh data or whatever the service or the event is, and you know, it works in a way that allows the application to run a lot more smoothly and quicker. I'm really bastardizing it, so if you guys are engineers or anyone that's a software engineer right now, I know you're not going to be very disappointed in me. I'm probably, you know, really oversimplifying what these tools and systems do, but obviously not everyone is a techie like that, so including myself. Like I'm into tech, but I'm not like a flipping solutions architect or anything like that, do you know what I mean? So I know it at a high level just to understand obviously how it operates. But anyway, it's doing its private beta for it, and it expects to be, you know, about 10-15 times quicker than AWS Lambda, quicker than Azure Functions, which is Microsoft Azure's cloud, and they've got a similar service, quicker than Google Cloud's platform services as well in terms of their functions. So if it can continue to do that, then, you know, this could be another new product offering that is going to launch into the market. And obviously they've got a massive client base already, you know, the likes of Shopify, LendingTree, HubSpot, Sony Music, and loads of businesses worldwide. In fact, they look after 12 million sites around the world. Another 20,000 customers are added to Cloudflare each working day, and so, you know, it's a significant business of a significant scale. They look after 11.6% of the top 100 websites used in the world. I think they'll continue to grow, personally speaking, and when they launch these new services, you know, they've got a client list that they can leverage, and also potentially they can get a lot more new clients added to this as well. So yeah, I added this to the watch list a month ago. Remember when free trade remember when free trade started to launch a lot more US stocks, probably about 6 weeks ago or something along those lines. I mentioned I added a few more growth stocks to the portfolio, and I mentioned things like I'm going to portfolio now. You saw I added loads of things like Splunk, Trade Desk, ServiceNow, Virgin Galactic, Autodesk, Akamai. So these stocks were added to the list about that time. Cloudflare was added at that same time, and it was around $30 a share. And as you can see from the holding, it's now sitting at, you know, $41 a share. So if I bought it at the time I added to my watch list, I would have made already 25% on this stock. Obviously, you know, I don't necessarily do things like that, and I don't see it as a loss. I see it as I wanted to monitor the situation. I wanted to, you know, keep doing my research on the business and then get that sort of confirmation and that validation that, you know what, this is going to be a good stock. It went up to about $42 this week, I think, and I wanted it to get to, can I scrub? Yeah, let me scrub. Yeah, it went up to about, we'll go 7-day chart actually. Yeah, I feel like it went to like $42 at one stage. Maybe it didn't, but it went up, and then I thought if it can get down to $40, then I'll pull the trigger. And it went down to $40 and so forth. So then that's obviously when I bought, and obviously I made my first investment. It's up 2%, which is nice, but obviously I'm gonna put a lot more money into this stock, just so you guys know up front. This is not my only investment into Cloudflare. I want this to be a very, very big position, because for me, you know, I feel like I want to put a lot more weight behind the growth stocks that I believe in. If I put, you know, 10k into, say, a Shopify and got 222%, then, you know what I mean, I'll be laughing making, you know, 20 grand profit, and that's what I want to try and do. Obviously it is going to mean me selling a lot of my other stocks that I lost, because, you know what I mean, the money ain't just sitting there in the vault like that, you feel me? But I think I can take the loss on some of those other stocks in the short term, and it will pay me back in the long term. So listen, man, this stock for me, it isn't a hype stock. You feel me? It's not a hype stock. It's not sexy, fam. It's not sexy. It's not a sexy stock, fam. But long term, hey, I think it could be the one. I think it could be a good one. So for me, remember to do your own research on any stocks. Please do not buy Cloudflare on my recommendation, or don't see this as a recommendation. It might be a terrible purchase. I'm not going to be right on 100% of occasions. I've not been right on 100% previously anyway. So, I do make bad stock purchases as well. So please do your own research. But me personally, from what I've looked at and from, the research that I've done, I'm definitely quite confident on this stock, and I'll be very interested to see how much this is going to be worth in 5 years. Do you remember probably about maybe like, I don't know, 3 months ago, I did a video, one of my portfolio updates. I talked about if you invested in all of these stocks at IPO, where they would have been in 5 years, then you would have been making like serious money with a lot of these stocks that previously IPO'd, the Facebooks, Apples, Googles, etc. I feel like Cloudflare is one of them ones for me. Like I just feel like this could be one of those stocks that if I get into it now, which is a year after its IPO, so I didn't obviously get it at the $18 mark. If you got at $18 mark, you'd already be over 100% profit. With Cloudflare now, probably like 125% or something along those lines. You know what I mean? So I feel like Cloudflare is like an AMD in nature. I feel like it's a stock that's going to do well over the next 5 years. And I'm going to give it a good shot, man. So yeah, you're going to see this stock is probably going to be holding about 5 to 10K in terms of cash. I'm probably going to put into this hopefully before the end of the year by selling other stocks mainly. If I can't do it, then I can't do it. That's the goal. You don't always meet your goals, you know what I mean? But I think it's good to have a target. So that's my target, is to probably try and make this to between a 5K and 10K holding. And then, yeah, just sit on it. Buy the dip when the dips come, and just see what happens in the next 5 years. And hopefully, man, I'll be laughing, man. And that's the whole goal for this. But yeah, man, that's the new stock. That's the new thing. Appreciate everyone that's taken the time out to watch this video. Hopefully you found this information interesting. Please hit that like button if you got this far. I definitely appreciate all of you guys' support. Get in the comments what you think about Cloudflare, if you know it, if you've invested into it before, if you thought about it, if you don't like it, if you've got things that's like, Curtis, man, did you not look at this part of the business which, shows that Cloudflare is going to go bust in like next week or something? Like, just let me know. Speaking of next week, Cloudflare actually's earnings update is next week, August the 6th. And I actually feel like it's going to have a good earnings updates as well. So I did want to get into it before its earnings update. Now, that has failed for me in Shopify and Microhard, but I think it's going to be good anyway. So yeah, that's Cloudflare. Added to the watch list. Sorry, added to the portfolio, not just the watch list. And we'll see how it goes, man. We'll see how it goes. But yeah, listen, have a good weekend. I appreciate your time, and I will catch you next time with another investment video. Take care, guys. Peace.